as we see you dressed all in black and advocating against the secrecy bill that's possibly going to be tabled. I mean, you're coming through from a very regulated industry. So run us through, the thinking as to why you're advocating an opposition to this.
Well, certainly, if one listened to Gareth Ackerman last night calling on big business to stand up and be heard, certainly from Adcock's side, anything that discourages foreign investment and perhaps moves us down in Moody's rating or Standard & Poor's rating, we would not condone. I think we've been a wonderful maturing democracy, and I think we've tried to move away from the issues of the past, and I really would not like to see this country moving backwards.
Absolutely. Well, as Eleni said, a very contentious issue at this stage of the game, and we'll wait to see how that plays out. In the meantime, a little bit more public are your results, so let's go through them. Improved headline earnings per share coming in, an increase of 31% coming through there, but on a normalized headline earnings basis, a decrease of 9%, illustrating that you have experienced challenges through the course of this year.
Certainly we've had some pressure. So if you account for the BE deal that we did last year, that's around 260 million rands worth of an abnormal item, if we call it, in the previous year, then headline earnings indeed are up 31%. If you discount that, then the true reflection of the business's performance is 9% down in HEPS. And that's driven really by two or three key factors. The first is the critical care business. As you mentioned, we are the largest supplier of hospital and critical care products, both to government and to the private sector, and at the moment embarking on a very large factory upgrade that has impacted both our supply and our margins. So the critical care business is at least 100 million rand shy of its performance last year in profit. And that's mostly because we've had to import product, and importing water over water is not particularly cheap. The other key issues were tender performance. So in antiretrovirals, we didn't perform as well as we had historically, so that's in the base. And then, of course, there's a contentious issue around DPP-containing products that have affected revenue to some degree as well.
Of course, those are some of the challenges, but there's opportunity that's come through as well, and that with your acquisition of Neutralida. What does that acquisition bring to your stable?
Well, the OTC business has really been a star performer in the current results. So if you look at it, it's more than 21% up. Most of that's organic. We're showing really good volume growths. We've always said that we wanted to get or enhance our offering in fast-moving consumer goods, move more into well-being, and also reduce our dependence on the single-exit pricing environment. What Neutralida brings is strong brands, Arthroguard, Viral Guard, Probiflora, LP299V. These are often well-known household brands, as well as the Natradale brand. We've already incorporated that business well into the rest of the pharmaceutical division, and we're very happy with its performance to date. So you'll see more of that in the future.
Looking at that diversification and how you're looking to leverage your earnings moving forward, I mean, is it necessarily a bad thing, the loss of your exposure to ARVs, to focus on higher margin businesses? Because in general, your exposure to the public sector, while bringing in volumes, have seen pricing decreases that have impacted on the business negatively.
Sure. Look, one always likes to focus on higher margin business, but we are aware that we're one of the largest manufacturers in South Africa. We employ 2,200 people in this region alone. 1,400 of those are black staff that are certainly recipients of our recent BE deal, and we need to keep those factories full. We also regard ourselves as a partner to the state. We supply more than 80% of the government requirements for critical care products. We have the capacity to supply the government when it comes to antiretrovirals, and we do supply a lot of other products on tender. So we need this balance between public and private sector in order to keep our factories full and keep people employed. So we really do still see that as an important part of our business.
Let's look at gross margins, because benefiting, as you highlighted earlier, from a strong rand, affected by imports of raw materials and then finished products as well. To what extent are we looking at a risk on your margins moving forward, given the kind of weakness that has now come through on the rand?
The challenge is that in a single exit pricing environment where last year we didn't get any price increase at all, you've seen rampant inflation for local manufacturers, costs of utilities have gone up, electricity, water, labor. We have all of these inflationary inputs, and of course now the rand has fallen out of bed. And certainly the imported fraction of active pharmaceutical ingredients is particularly high in most of the products that we make. So the ability to offset that is very, very difficult. We can't just simply cut costs, lay off staff, reduce marketing spend, etc. We've already done what we can, But ultimately, for local manufacturers, I think what we do need is some element of softening on government side when it comes to at least a single-digit price increase. So we are in dialogue with them at the moment on that.
Does a weaker or stronger rand do you more favour? Because we know that 39% of your revenue currently comes outside of South Africa's borders.
39% growth outside of South Africa. I wish it was 39%
growth. Let's correct that. Yes, so just only making inroads and forays outside of South Africa's borders.
Only 4% comes from outside South Africa. So certainly our aim is to grow that proportion. We've said we want to be a stronger competitor in the rest of Africa and expand into other emerging markets over time. But at the moment, we're very dependent on the vagaries of the rand.